Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Casella Waste Systems stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Casella Waste Systems is a waste management company. It is a regional, vertically integrated solid waste services company. It provides resource management expertise and services to residential, commercial, municipal, and industrial customers, mainly in the areas of solid waste collection and disposal. The company provides solid waste services in 7 states: Vermont, New Hampshire, New York, Massachusetts, Connecticut, Maine, and Pennsylvania. It owns and operates 51 solid waste collection operations, 65 transfer stations, 23 recycling facilities, 8 landfills, 3 landfill gas-to-energy facilities, and 1 landfill permitted to accept construction and demolition materials. The company is headquartered in Rutland, Vermont, and was founded in 1975. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 4.3 billion market cap. They're trading at $84 a share, and they have 51 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have positive and pretty consistent free cash flow each year. It was low in 2019 at 14 million. It peaked in the trailing 12 months at 50 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes up every year from 6 million to 95 million. Revenue is the sales for the company, and that also increases every year from 660 million to 850 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that increases each year from 207 million to 295 million. Below that is their operating expenses, and these are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, which also grows every year from 52 million to 82 million. Below that is the interest they pay in their debt. That does seem to be going down. It was 21 million in the trailing 12 months, down from 26 million in 2018. And below that is other income and expenses. These are all the gains and losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which went up a lot from 6 million to 95 million. So the income statement looks pretty good. This is the income statement from their 10Q, the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. The top line is the revenue, and that third quarter revenue went from 203 million up to 242 million. And they break up their states into the eastern part and western part. Half their revenue are the fees they charge for collecting the garbage. That was 118 million, 70 million in western states, 50 million in eastern states. All of the states they operate in are on the eastern part of the United States. But within the eastern part of the United States, they break that up into eastern and western. They receive 25 million from their landfills, 27 million from transferring the rubbish, 3.4 million from transportation, 1.3 million of landfill gas to energy. In case you were curious what landfill gas to energy is, the waste at the landfill decays and emits gas. They have to treat that gas, but then they can use it for fuel for engines and electricity. And they receive 30 million from processing and 36 million from non-processing. Sometimes Casella has to process the waste and sort it. The cost of operations is 154 million. This includes the gas for the trucks, the payroll for the employees on the front line, and all the expenses at their facilities. General and administrative are payroll for support functions and rent in its corporate office. 27 million of depreciation and amortization. They do lots of acquisitions, so they had 1.9 million of expenses from those acquisitions. Sometimes landfills get closed down. There's lots of remediation expenses to get rid of all the pollutants and to clean up that area. So this company has to sometimes pay a fee or a penalty. For their Southbridge landfill, they were hit with remediation expenses of $2.6 million in the third quarter of 2020, $300,000 in the third quarter of this year. So it looks like they're getting to the tail end of cleaning up that area. So they do have positive operating income every year, and it grew from $21 million to $27 million. They paid $5.2 million of interest on their debt, and their net income went up a little bit from $15.1 million to $15.9 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a decent amount of cash flow each year, and it did peak in the trailing 12 months at $162 million. They do have to spend a lot on CapEx each year, around $100 million a year. They have to do lots of construction at their facilities, so the cost of that goes in the CapEx. Operating cash flow minus CapEx gives you your free cash flow, and they do have positive free cash flow each year. It looks like they added stock in 2019 and 2020, $100 million and $145 million. They added about $50 million of debt in 2018. They paid down about $50 million of debt in 2019, and they added a similar amount of debt as they paid down in 2020. But it seems like they're paying less interest on their debt, so they must have refinanced at a lower interest rate. Here's their operating cash flows from their 10Q. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with net income of $32 million, we add $75 million to depreciation and amortization. We add back all the other non-cash items on the income statement, and we also have to adjust for changes in working capital. They took on $20 million of accounts payable, so that's a cash inflow. Even though they reported an accounting profit of $32 million, they actually generated $134 million of cash flow. Last year was an accounting profit of $28 million, and they generated $112 million of cash flow. These numbers are just for the first 9 months of 2020 and the first 9 months of 2021. Here's their cash flow from investing and cash flow from financing section. They do a lot of acquisitions. Last year they spent $25 million in acquisitions. This year it's $153 million. They also put money back into their business in the form of CapEx, property, plant, and equipment. $77 million last year, $82 million this year. Last year in the investing section, it was a cash outflow of $100 million. This year, it's a cash outflow of $230 million. There's not much going on in the financing section this year, but last year they borrowed $150 million of debt, and they paid down $145 million of debt. This year, they just borrowed $500,000 of debt and paid down $8.5 million. So this year in the financing section, it was a cash outflow of $8 million. Last year was a cash inflow of $8 million. This is the equity section on their 9/30 balance sheet. They have $400 million of equity. They raised $650 million from selling their business, and they lost $230 million from running their business. Accumulated deficit is a sum of all the company's prior net incomes. They have positive net income for the past few years, so they must have just recently become profitable. Since they have an accumulated deficit of $230 million, they must have had some large negative net incomes before 2018. Let's look at the capital structure. $400 million of equity, $618 million of debt. They have 40% equity, 60% debt. And I gave them the whack on Simply Wall Street, 6.33%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.2 billion. We divide that by 51 million shares. And we get a calculated stock price of $23. They're trading at $84, so they're trading at a 259% premium. It's a sell according to the model. Their revenue is projected to increase 7.8% a year. So I increased their revenue 7.8% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by the sum of these 4 revenue numbers. That's about 5%. I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. So obviously the market does not agree with me, because the market's willing to pay $84 a share. I'm saying it's $23. So like I said before, this is just one tool to figure out if you want to buy a stock or not. The market really dictates the stock price, not the underlying financials. Simply, Wall Street's also saying the stock is overvalued. Their valuation is $54 a share. 3 analysts priced this stock and the average price target is $93. This is the stock price the last 2 years, and it's just been going up and up. Ironically, the stock price down here is a lot closer to my valuation. And the company's doing well. They're not doing amazing. Their net income and free cash flow are just a little better than prior year. It's not like they're doubling and tripling their revenue. But apparently the market felt the stock was really undervalued because they more than doubled their market cap in 2 years. They have a beta of 0.94, so the stock moves with the market. It's gone up 41% in the past 52 weeks, while the S&P is up 29%. The 52-week low is 53, the high is 90. And the stock is trading between its 50-day and 200-day moving average. 200,000 shares are traded each day on this stock. Pretty much all the shares outstanding are on float. Institutions own most of this stock, and a little over 1% of the shares are shorted. Their employee count has been growing, but pretty steadily over the past few years. They currently employ 2,500 people. They were employing about 1,900 back in 2016. If you invested $10,000 into this company 10 years ago, you would have made a ton of money, up to $132,000 today. But if you invested $10,000 10 years ago, after 5 years, you would have gone nowhere. You would have been in the red for about a year and a half, and then again in the red for about another year. Most people could not sit on a stock that trades sideways for 5 years. But starting from this point, it grew dramatically. There's been lots of insider selling, no buying in the past year. These are all the people that sold in the past year, the dates, the number of shares, and the price they sold at. Most of these people would have been better off waiting because the stock price just kept going up. Of course, at the time they sold, they didn't know that. 97% of the shares are held by institutions and 3% by individual insiders. Vanguard owns 9% of the company, 4.6 million shares, with a valuation of $388 million. Ernest Partners, BlackRock, and Allspring. Let's look at their financial ratios. Their PE is a bit high at 45. That's much worse than the market median and average. PE is stock price over earnings per share. Their price to sales is decent at 5.1. That's stock price over sales per share. And their price to book is a little high at 10.5. That's stock price over book value per share. Let's look at their non-current assets. $617 million of PP&E, $97 million of operating lease right-of-use assets. This is when the company leases some equipment or its landfills. $228 million of goodwill. Goodwill is the premium you pay when you acquire another company. $93 million of other intangible assets. $2 million of restricted assets. Restricted assets are usually cash or maybe securities, something of cash value that's set aside to pay for a specific obligation. $11 million of cost method investments. That's the value of their investments in other companies using cost method accounting. So it could be stock they own in a public company, and the value of that stock is $11.3 million. Deferred income taxes of $47 million. These are taxes the company will eventually pay, but are not yet due. The reason a company has deferred income taxes is the difference between the way GAAP accounts for taxes and the IRS accounts for taxes. And $18 million of other. Their return on invested capital is 6.6%. They can cover their interest payments more than 4 times. They have a really good ROE at 23%. Their current ratio and quick ratio are slightly below 1. Let's look at their current assets. $46 million of cash, $91 million of accounts receivables, $17 million of prepaid expenses, $10 million of inventory, and $3.6 million of other. Let's look at their current liabilities. $17 million of debt, $7 million of operating lease liabilities, $70 million of accounts payable, $20 million of accrued payroll. Accrued capping is a cost to close their landfills. That's what this $18 million of current accrued capping, closure, and post-closure costs is. In the trailing 12 months, they had $50 million of free cash flow, and they have negative $11 million of working capital, so they have $38 million of funding. They should have enough money to get through the next 12 months without taking on any more debt. but they seem to acquire lots of companies every year, so they're probably going to need to add debt for that. The best way to look at ratios to compare them to companies in the same industry. There are 18 companies in the same industry as Casella, and their debt to equity ratio is a little worse than average, but pretty close to average. They're 1.5, average is 1.4. Only the 4 biggest companies in this industry pay a dividend. Their free cash flow is a lot lower than average. In terms of market cap, they're the 7th largest company, and their price multiples are worse than average in every category. Because 2 years ago, when their stock price was half what it is now, their price multiples were probably pretty much average. Now they're much worse than average. Because the numerator for all the price multiples is the market cap. The higher the market cap, the worse these ratios are. Their revenue is $848 million, average is $2.7 billion. Their 5-year annual growth rate is 9%, average is 3%, so they're doing really good in that category. Better than everybody in the top 6 except for Waste Connections. They have a good return on assets, much better than average. Average is negative. And their ROE is bigger than most companies on this list. Waste Management is slightly better, and so is Sharps Compliance. They're also better in ROE. ROE is net income over equity. ROA is net income over assets. So to summarize, I have them trading at a 259% premium. But waste collection is a very important service. It's not as simple as just collecting garbage and throwing it away. Because if you did that, there would be tons of problems. There's proper ways to dispose of certain garbage. And of course, you have to make sure people are recycling properly. Because if they weren't, the garbage would just keep overflowing. Recycling is a good way to reduce the garbage. Plus, this company's job is to try to reduce the garbage by compacting it at their locations. So it does seem like it's overvalued, so I probably stay away from it. But as you know, the market has a mind of its own, which is very unpredictable. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.